Here, it's Stephen Thomas with Reports on Housing with yet another housing debrief. Thank you for joining us. I'm going to ask for everybody to gently tap the like button. If you could please gently tap that like button and also maybe gently subscribe to our YouTube channel. That'd be fantastic. We want to get as many people to view the real good, solid facts and data as possible. This week, we're talking about the collapse in home sales because really the number of home sales that across the United States on a monthly basis are way, way down. And we're going to focus in on SoCal. And you can see in SoCal, we're going to looking at all the closed sales from 2016 through 2023, relatively the same number of closed sales year in, year out. 2021 actually had the most sales since 2005. But all the other years were relatively similar. In 2022, it was starting off okay, and then it really collapsed as mortgage rates went up. And then in 2023, we're going to focus in on 2023. You could see where it's starting right now. It is very, very low. So in 2022, it really plunged the number of home sales and got down to a level at the end of December where, and I drew an orange line across, it is an extremely low level. We haven't seen any level like this since probably right around the Great Recession. So, but that does not mean we're in the Great Recession. We're not in any major downturn like the Great Recession where we have plunging values. That's a totally different marketplace. It's just in terms of units. And there is a recession that's going on in housing. And the recession that we're experiencing right now is not a recession on home values where we're seeing home values absolutely plunge. It's sheer number of units, number of closed sales. Everybody in the real estate industry is dealing with fewer closed sales across the board. It affects everybody that works within the real estate industry, from mortgage to title to real estate agents, inspection companies, escrow companies, you name it. Anybody tied to the residential resale, it's affecting them. It's also affecting like Home Depot, Lowe's. You could see it in their stock earnings. They actually had a real big miss, and that's just because we have a fewer number of new closed sales. So a lot of these people do a lot of work once they close their sale, once they close their home, and at that point they go to Home Depot, Lowe's, and they fix up their house and all that stuff. So it really is a recession as far as it is a drag for anybody that's tied to the real estate industry, but not for the homeowner. The homeowner is not seeing a tremendous loss in value. There was a loss in value as everybody was adjusting to the higher and higher and higher interest rates, and that was from May of last year through about January of this year. But since has turned around and has done a 180 as far as the market's concerned. We have values that are going up, yet we still have a lack of closed sales. So we bounced off of a low number as far as really low closed sales in December, but it's not bouncing back that much. And values, it bounced from going down to it's now positive, but we're not going to see it in number of units yet. We really need to see mortgage rates come down in order for that to happen. So as far as Southern California closed sales on a month-over-month basis, you could see right here that in 2022, those are those orange bars, you could see that there was this slope down. Usually it goes up and then comes down, but this slope down started in March and it got to a smaller and smaller value as the year progressed until they got to December. And you can see how low December is compared to all of the prior years. The purple bar is actually 2019. And if you compare 2022 to prior to COVID, it's actually off 18%. So it was looking like a strong year as the year started, but then it trailed off and it was off 18%. And you can see this in the number of closed sales on a annual basis, 163,814 in 2022 versus you could see how there were so many closed sales in 2021, but you could see the overall average is probably right around 197,000, I believe is what my calculations were. So There aren't as many closed sales in 2022 compared to prior years, and then that leads us to 2023. And what's happened in 2023 is it left off where December was at. We saw a normal rise as the year progressed, but it's still overall for the first 4 months is off 31% compared to prior to COVID. And you could see where prior to COVID, you can see the purple line. That was a year pre-COVID. That was 2019. And you can see the slope of it that it was increasing at a higher rate than what we're experiencing this year. Those are the blue bars for 2023. And then if I forecast the first 4 months of the year and forecast based upon the first 4 months of the year, what will the rest of the year look like if it was off by 31%? We would see 136,000 closed sales. Is this where I really think things are going to go? Well, I actually think that we're going to see interest rates come down a little bit, which then we'll see demand come up. But the problem is there's not a lot of homeowners that are coming on the market. So it is really eating into the number of where my demand readings are. Our demand readings are recent pending sales the last 30 days. Part of it is an affordability issue, but another big part of it is the lack of homes coming on the market. In some markets, like San Diego County, there's 53% fewer homes coming on the market. But overall, for all of SoCal for the first 4 months of the year, off 42%. So we're missing 42% of the number of normal sellers. So that's eating into the number of pending sales that we're currently experiencing. As a result, because there are so few homes that are going under contract because there aren't that many coming on, it is eating into the number of closed sales. And that is where we get that 2023 prediction of around 136,000. I think we're going to see interest rates come down. We'll see more demand, and it should get to the point where we're going to invite a few more homeowners to play rather than continue at this rate of 42% fewer homes coming on the market for the remainder of the year. And so if you look at just closed sales, there are so many people that jump to the conclusion that, boy, this must be a crash. This has to be a crash. But that's just not what it is. But first, I'd like to thank our sponsor. And our sponsor absolutely specializes in reverse mortgages. This is a product for seniors where you could purchase something and then not have a monthly payment and still have a mortgage on the property. So it allows you to purchase something, but you are not paying a monthly payment. And this is Senior Financial Group, Inc. They're your reverse mortgage expert today and for years to come. That's what they specialize in, reverse mortgages. And that's Kevin Kaltenbach. He's the Senior Financial Group, Inc., reverse mortgage specialist. You can reach him at 949-910-0932. That's 949-910-0932. And with reverse mortgages for purchase loans, you can help your senior homeowners sell their current residence, use the equity to buy their next primary residence, and in one transaction, with no monthly mortgage payments. It's that simple, but Kevin knows all the details and the steps. He's been doing this for a super long time. Senior Financial Group, Inc. Has been doing this since 2001, and Kevin's actually a 2023 director at Orange County Realtors. You can reach Kevin Kaltenbach at 949-910-0932. That's 949-910-0932. Thanks, Kevin, for your continued sponsorship. We really appreciate it. Now back to the program, and we're talking about that crash. Well, we're not going to have a crash because the survey says, that's right. We're not going to have it. Yes, we've experienced a slowdown. Yes, there are fewer units that are taking place. Yes, there is extremely low demand. And we've talked about the low demand. You could see it year over year. You could actually see it in this wonderful chart where we go back to 2013. 2014 was a little bit muted because we had higher interest rates then. Then 2015, 16, 17, 18, 19, it really dove down by the end of the year. 2018 dove down by the end of the year. And 2019 was a healthy bounce from 2018. That's where interest rates went to 5% in November of 2018. In 2020, we have COVID. That's where there's that canyon. But then we had this late spring for 2020, and it was a phenomenal summer, autumn, and holiday market. 2021 most sales since 2005, and you can see that giant number of pending sales. That's with demand. And in 2022, you could see it really fall off as the year progressed and got all the way down to where it bottomed out. And in 2023, it's not off to the races. There's about a third of the missing demand currently in the marketplace. And you can see it in Southern California demand. Last week, we were at 11,847. Looked like we kind of have seen a height a couple weeks prior. And last year at this time, we had 15,188 pending sales for the last 30 days. That's 28% higher than where we are today. That's that orange line. And today we're at 11,881. No real big difference. So where are we headed from here? Well, where we're headed is it looks like it's going to remain kind of flat and then come down, kind of follow the 2022 orange line. But if we all of a sudden get interest rates to come down enough, if the economy slows down, we are going to have interest rates that are lower. And at that point, we will actually see increased demand, and we'll see some more homes come on the market if interest rates come down far enough to about 5.5%. If that happens, then we'll actually see a rise in this demand curve, and 2023, the second half will be better than the second half of 2022. And that's kind of what we're thinking is most likely going to happen, but it's anybody's guess as to when the economy is actually really going to slow down, so we're watching that very carefully. So we talked about of course we have low demand because interest rates have risen so much. But what everybody's forgetting about is because interest rates have risen so much, we have a very, very low supply. We actually have homeowners that are not placing their homes on the market. And you could see it again, 2013, 14, all the way through. You could see 2018, we built an inventory off of 5% interest rates. Then 2019 came along. In the second half of 2019, the number of homes really dipped. We got into 2020, COVID hit, and then it dipped even further with fewer homeowners coming on the market and demand rising because interest rates hit record lows. 2021, it came down even further, and we started off 2022 with very few homes on the market. Interest rates continue to rise throughout the year, so we built up an inventory. But this year, we're having a real hard time building an inventory. And once again, 2023 looks very low compared to where we were in prior years. And you could see it in the numbers. Last week, we were at 18,212. And last year at the same time, we were at 18,976. It actually dipped below last year for the first time since April of last year. So year over year, there are fewer homes on the market in all of Southern California. And it's very, very close to that red line, which is 2021. And that was the lowest level that I had ever seen since tracking. There are some markets, LA, Orange County, and San Diego, that are actually below that red line. And it is the lowest point ever for going back to 2012 when I did all of SoCal for the month of May. And today we're looking at 18,489. So it is going up slightly, but it's supposed to. It's actually, this is where it goes up. Pre-COVID, it was at 38,461, which is 111% more. Do you know what 111% more means? It means more than double. And there are some markets where we should be triple where we are today. So where we're going to go from here, it doesn't look very promising because we're not adding that many homes on a weekly and bi-weekly basis and a monthly basis. And we don't have that much room because typically, where does it peak? It peaks during the summer between July and the third week of August. And then people don't place their homes on the market. So that's because families like to participate during the spring, close during the summer, and then after that, families don't come on. So it's a segment of the marketplace that is missing for the most part. And then as a result, we peak during the summer and it comes down. Now, where it's going to go, it's going to follow that red line. It's going to be very, very similar. And in some markets, it will still remain at the lowest level since tracking began. And it's mainly along the coast in SoCal. And so what about the market? How fast is this market? So the interest rates going so high, intuitively, everybody thinks that the market should tank because demand's going to go down. But what has happened is interest rates have gone up so high that, yes, demand has come down, but so has the inventory. The inventory has come down to where it is still at very, very extremely low levels. I called it crisis. I also called it catastrophe. Where it's at right now, if you talk to many agents, they have buyers that want to purchase, but they just can't do it. And the Southern California expected market time, it is looking like this. It's very, very hot compared to prior years. If I show you where we're at right now, that's where that orange line is. This is a really, really hot level. The only time it was hotter was for a brief moment in 2013 and throughout COVID, between the second half of 2020 all the way through the first half of 2022. And then, so the expected market time is you place your home on the market when you're opening up escrow. It's not days on market. It's based upon the available number of homes to show your buyers today. And it is, and then it's also based upon the velocity of demand. Because when there's changes in demand or changes in inventory, this will affect the expected market time that we track. And last week, I'm pointing at that blue line, last week was at 46 days. That's a really hot level. And last year was at 37 days, but it was growing really, really fast on a week-to-week basis. That's not what's happening here. Because today it's at 47 days, it went up one day, but last year at this time it was going up by several days, even a week at a time, and that's that you could see the trajectory of the orange line last year. So we're going to cross right through that orange line. In some markets it's already happened, or it's about to happen in the coming weeks throughout Southern California. So where are we headed from here? It's not going to change much. It is going to remain below 60 days. And when it remains below 60 days, that's a pretty hot market where it's telling me that we're dealing with multiple offers. We're dealing with sales prices above the asking price. So the sales to list price ratio is greater than 100%, which means there's a lot of homes selling for above the asking price. So it is a seller's market right now. I know that home values are rising as a result. And I also think this is an extremely unhealthy marketplace. There are a lot of people that think that there's a lot of buyers in the marketplace. And I want to explain this really quick, that there are a ton of buyers in the marketplace. And there actually are not, because of affordability. Affordability is greatly diminished, so there's not a lot of buyers in the marketplace. But if you're a buyer today in the marketplace and you're going out looking at houses, you feel like it's just like it was during the second half of 2020, all of 2021, and the first half of 2022 for those 2 years. And that is how hot the market is, with lots of people lining up for open houses to see properties. You're bumping into the same people, and you're writing offers where you're competing against 10, 15, 20 other people. So the reason this is happening is because I liken it to, Disneyland is a great example. So let's say that you have a summer wave of people that are going to Disneyland. Now all of a sudden they jack up the prices and it's twice as expensive, and now only half the people are going to go. So you would intuitively think that that all the lines would be walk-on. But let's say that there's not a lot available, the rides, and they cut the number of rides available in half. And then all of a sudden there's half the number of rides that are available. So if half of the summer volume comes in, but yet there's only half the rides, you go in there and the lines are just as long. That's the frustrating part of this market, because these high interest rates, yes, they made it more costly to go to that amusement park, to purchase a home, and yet there aren't that many homes available. There are not a lot of homeowners that are opting to sell. So there's not a lot of for sale signs that are out there. So those fewer buyers are chasing after the same homes. It's like they're chasing after the crumbs that are available because there's a lack of homes that are available today. So I want everybody to go and subscribe. If you want a copy of this, you can subscribe. All of our subscribers automatically get a copy of this presentation as a PDF. You can go to reportsonhousing.com to subscribe. That's Reports on Housing. And the most recent one that came out, Orange County, LA, San Diego, got theirs this week. It's hype versus data. Next week will be San Bernardino, Riverside, and the Bay Area. We just dropped the Bay Area report. And if you would like a free month, go ahead and scan this QR code and utilize the coupon code DATA for a free month. And you too can get the most recent report and make a difference in understanding exactly what's going on in the marketplace. You could share it with friends, family, clients, you name it. That's what it's there for. So I appreciate you tuning into another housing debrief. I hope you have a fantastic finish your week, and I will see you on the other side.